All right, I'd like to welcome everyone that's here today. I'm Boyd Peterson. I'm actually just going to be moderating, and so I'm going to be introducing Clay Neves and Ron. Clay will then introduce Ron Haycock, and then Ron will actually introduce Lyle, who is a special guest that will be presenting later. And so, what we'll be doing is for the next hour, maybe a few minutes longer, depending on the questions you have, we'll be running this show for you. So thank you for being here. And we're going to get started now. So I'd like to introduce Clay Neves. I've known Clay for about 25, 28 years, something like that. He used to work with the Chamber of Commerce, but over the last 15 or so years, off and on, he has been teaching people and getting people who are both accountants and bookkeepers so that they understand business and how important it is to business owners. And so we've asked him to be our first speaker. He is with Pratt and Lefevre. He is the national sales director. And so I'm going to turn the time over to Clay.
Well, hello, everybody. I hope you're having a great day. And it's that time of year once again that small business owners ignore, much to their, much to their chagrin a little later on. I'd like to start by just sharing my presentation here for a moment. So let me just share. And if you could just give me a thumbs up once I share this, that you're able to see it okay, then we can proceed through. My purpose is to go over with you the basic protocols that all small business owners should be doing at about this time of year. Actually, I'd say it's best to start this in, in earlier October or late October, just to give yourself a lot of time. Now we're in the middle of November, which leaves us about 45 days, which means that if you haven't started on this, it's time to start. But here are some of the considerations generally that small business owners should be making at this time. I'd like to get through my material as quickly as possible to leave Ron some time for some more advanced strategies that are designed not only to help you lessen your tax liability, but perhaps even eliminate it altogether ethically and legally. And so I'll just go ahead and get started so we can get through my presentation and on to um, the main feature, and that is Ron's presentation. First of all, I just want to put a question out there. What is the difference between tax planning and tax preparation? The answer is December 31st. After December 31st, it's no longer tax planning, it's only tax preparation. You can't do anything about your tax liability after that date. And so it's really important right now to make sure that you're doing what you can, getting with your accountants or your accounting program or whatever it is you're using to keep track of your business, your income, taxable income, all of the things that we use to calculate your tax liability and know where you are so that we can start to strategize where we want to be by the end of the year to eliminate where your tax liability now while we still can, because after December 31st it's too late. Okay. um so let's talk about financial accounting, uh update, cleanup. You want to make sure that if you have been really good in keeping your accounting up to date all year, this part will be easy. You just want to go over it again and make sure everything is in order. If you haven't got your operations in order yet, you need to get with a qualified accountant and you need to get your books together now. A lot of small businesses, the problem they have is they wait until after January or December 31st to put their books together for the year. And that's too late to know how I'm going to manage and how I'm going to control my tax liability. So if you haven't done your books, you need to get them professionally done. It's worth every penny. If you haven't, especially if you haven't had or don't come from an accounting background, there's a good chance that you don't even know what you don't know that you need to know in order to do it right to maximize your tax liability, if that makes sense. And so it's important to make sure that you've got your bank accounts all reconciled, credit cards, loans. Make sure that you're looking at your accounts receivables and payables. You want to make sure that you're able to know where you are so that you can write off any accounts receivable that just aren't going to be collectible now instead of not being able to after December 31st, where you can pay ahead, maybe some expenses that might fall into next year, but in order to maximize your deductions this year, you might want to pay them early. Make sure that you're looking at your payroll reports. Usually, payroll is one of the two largest expenses, tax deductible expenses you have. Uh, Payroll and advertising are usually the two for a small business. You want to look at your owner draws, your distributions, and what you have put into the business as capital contributions to know where that is so you know which way you need to go moving money in or out of your business to maximize your tax savings. And you want to make sure that all of your fixed assets are recorded properly, that you've got all of the paperwork in order there. We're going to talk a little bit later about depreciation, which is really important as far as that. Make sure that your inventory is up to date and adjusted for shrinking and waste. Of course, both deductible expenses. The second thing you want to do, excuse me, is look at your income and expenses and how to optimize those by the end of the year. You want to make sure you can accelerate income or defer income. Excuse me. So if you're doing a having a banner year and would like to maybe lower your tax burden, it's good to defer some of that income into next year. If you're looking like you're having a poorer year this year, but next year's going to look really good, you may want to accelerate some of that income into this year to take it out of next year. These are questions that you need to go over with your accountant. Uh, Again, if you're looking at for this year, prepay all allowable expenses, what you can. Make final equipment purchases. If you're thinking of purchasing something or in the process of purchasing it, get it done by December 31st so that you can get that expense into this year, as well as some of the depreciation. And make sure that you're capturing all your business expenses. Make sure also that you're paying business expenses out of the business account and not your own personal pocket and intermingling business and personal expenses and or funds. The third thing to look at, I'm sorry, I swallowed some water down the wrong pipe. You want to review eligibility for any research and development tax credits. There's a lot of tax credits. This is one of the greatest advantages of being in business is that there's a lot of tax credits out there A lot of them you may not even be aware exist, but a good attorney or a tax preparer or CPA or an enrolled agent would know about these and can help you take advantage of them. But here's some of them that we've listed that you might want to look at. We also then want to look at, fourthly, what about, again, this is my usually largest expense, is payroll, contractors, including any benefits I offer my employees, those kind of things. I want to make sure that I'm getting ready to make sure my W-9s get out, my W-2s get out, my 1099s get out, and that all of those filings are done in January. But this helps me also understand, do I want to make some extra contributions to the 401k if I have those, the IRA, the HSA, or other accounts I might have set up for them. And then if you are an S corp, make sure that you've got a reasonable owner compensation in there as required under an S corp. So just make sure that your payroll is right. The fifth thing that we want to do is make sure that we're reviewing now our tax position and kind of running some what ifs, some contingency cases, and looking at what the tax burden might be under the different entities. So, for example, at this point of growth in my business going into next year, is it still good to file this year as a C Corp or an S Corp? Might be better, or is it time if I'm a sole proprietor to move up the chain a little bit? And do I want to am I ready to move into a multi-member LLC, or would an S Corp or C Corp be better? And how does that compare to how I'm currently registered as far as the tax burden and the tax advantages that I have under each of them? You can see why I'm saying this should be taking place, toward the first of early October, late October, because it does get scary after Halloween. Um, and so that's another consideration to have. We also want to make sure that we understand the cash flow of our business. This is another tool that we have to consider in terms of, if I am going to be sucking money out of this year to pay for things I would have otherwise paid for next year, how does that affect my cash flow? Because I don't want to necessarily put myself in a cash uh, crunch just to save on some taxes. I have to balance those two, and that's always good to get another person involved who's had some experience across a lot of different clients on how to make that balance work best for you. So reassess, your projected income versus actual results, taxable income before year end. You want to review withholding for owners and high earning employees. Make sure that you've got all of your withholding taxes right, because you'll have to account for that as well. The the cash flow also is something that you can manage on an ongoing basis, in terms of accelerating payments in and delaying payments out, and how you manage your AR, your AP, your credit policy, your invoicing policy, those kind of things that can help you regulate your cash flow. We also want to look at and take an assessment, if we haven't already. This comes from your balance sheet. You want to look at your assets and your liabilities and see how we can now moving from the income statement and the statement of cash flows, move into the balance sheet in looking at our assets. Um, what schedules do we have for depreciation? How accurate are they? Am I following the right depreciation model or the optimum depreciation model for my particular business? You want to make sure that you're evaluating disposing of obsolete equipment, writing it off, write off fully depreciated unused assets. If you're looking at buying major capital purchases in the coming year, assess the advantages of perhaps buying them this year, again, balanced against cash flow issues, and managing, maybe you want to buy them on debt or other ways to maximize your tax or optimize your tax liability. And then, for future equipment, do I want to buy it now or do I want to lease it? And how is that impacting my taxes as well? We want to make sure that as we're approaching year end and going into the new year, that we are compliant with all tax and business regulations and laws. So one of the things you want to make sure of if you're doing interstate commerce at all, even if you're doing direct mail, or I'm sorry, online e-tailing, or you're doing anything where customers are out of state, what type of sales tax nexus do you have in those states, and what sales tax might be required in those states? Some states don't count it yet. Um, Internet sales, some do. So it's just important to understand your liability to other states under sales tax. Make sure to prepare your year-end filings for that. Check your business licenses. Make sure they're up to date, that they don't lapse. You want to review your state franchise tax requirements, if any. Complete the preparation of your formal corporate minutes if you're a corporation or an LLC, that all of your meetings and resolutions and all of the required paperwork is filed, the records of your meetings, and prepare for your annual report filings as required depending upon the state you're registered. You want to also make all of this part of a strategic planning process for next year. You want to go back to your income statement, your balance sheet, and your statement of cash flows to make sure you understand the trends, what key performance indicators you were shooting for. Did you meet them? If not, why not? Um, Qualitative analysis. It should have been part of your KPI goal setting at the first part of the year. And if you're not meeting your KPIs, then you look at the contributing factors of that KPI to see and do a more qualitative um, analysis instead of just the quantitative analysis. Quantitative analysis, looking at the numbers on your different reports, will tell you where the problem is if you know how to read them. Your accountant, again, can help you with that. But they will tell you they won't tell you, they'll tell you what the problem is, but it's the qualitative analysis where you know now what the problem is, to go out and find, or they tells you where the problem is. Now you need to go out with your qualitative analysis, maybe on the sales floor, maybe on the production floor, maybe through observation, maybe through surveys and some other things that you can do to find out what the problem is, why the problem is, and how to solve the problem. And so those are things that will all come out of this. Pricing is such a key issue of this. Most of the clients I work with are grossly underpriced. And we found in most cases they can raise their prices by 10% and actually make more money with just a few less clients. Usually the clients that leave because you raise your prices are the ones that take the most, uh, that are the most hassle anyway. Your best clients will probably not leave with a 10% increase, or new clients you may not lose any new business, but if you're not having some people tell you that you're priced too much, if you're not losing some business on price, you're priced too low. That's just a thumbnail I go by. You want to
Hey,
make, yeah.
I have a question about KPIs. What are some good KPIs that they should be thinking about? I know
Oh,
you've just mentioned a couple, but I know
yeah.
there's others.
So, for example, if you're advertising for leads, for example, you want a good KPI there is your lead cost per lead. Now that tells you how much your lead cost you, but it's not really the end all. You need to factor that against the real measurement of your advertising efficiency and effectiveness is lead cost per sale, which is just your total lead cost divided by your total sales. And, that'll tell you your return on investment, and you should be making that analysis by lead source so that you can stop paying for the ones that aren't paying you back and reallocate that money toward the ones that are paying you back. In other words, the whole purpose of management and accounting is to hold every single line item that you spend money on accountable for either directly or indirectly driving top line sales. Okay. And doing so profitably. Now, some of this may not be quantitative. It may be more qualitative. It may be something you need to reason through logically. But there are ways to set up management and measurement systems for almost all of that to make it quantitative as well. But stop spending on the ones that aren't driving sales and reallocate that expenditure to those that are bringing you in the most measurable return in sales to the top line. Does that make sense? So you can easily do this by employee, for example. You should have a KPI. Every one of your employees should have a performance standard, a major performance standard, a KPI that if they meet that KPI, probably the rest of their performance is going okay. So for a salesperson, it might be total revenue, and what is that revenue they need to bring in to pay for themselves and to pay for the clients they bring in, because every client bears a cost as well. And so if they can vary the pricing a little bit, you might want to look at um, net their net income based on the sales they bring in. If it's on the factory floor, how many pieces can they put out per hour of time might be a good KPI. One overall that I really like when working with my clients is total revenue per employee. And it's one of the best overall measurements of how well you as an owner are managing the business. If you add an employee and your revenue per employee goes down, you're not managing it correctly. Every employee you hire should either directly or indirectly help drive revenue to the top line. That doesn't mean that every employee becomes a salesperson. But for example, if I hire even a janitor, how do I want to make sure I hold him accountable for doing the things that will most either attract or retain clients? If I've got a little restaurant, if that restroom is dirty, they're not coming back. If he keeps it sparkling clean, they probably will come back. It's part of the experience. So, how do I make sure that bathroom is clean and how do I measure that? Maybe I go in and do an inspection at different times during the week and I have a score for him. Well, that kind of indirectly helps drive sales to the top line. And so, those are some KPIs. Now, there are about 19 really good ratios. And if anybody would like a list of those ratios, I'd be happy to send them to you. If you put your um, if you put your email address in the notes, okay? And Boyd, if you could just make sure I get those, I'll send that list to everybody. And if you need any help with those, I'll be happy to cover them with you. And that might even be another good webinar sometime. Does that answer your question, Boyd?
All right. Yes, it does.
Okay.
Okay, go ahead and continue.
And
Sorry.
then look at your forecasting for next year. Again, for example, one of the best owners I ever worked for, I was over the sales end of the business. And when we did our year-end review and New Year planning, he said to me, Clay, what are we going to sell next year? We did X amount this year. How do you want to grow it? What is your target for next year? And I tell him that's what I needed to bring to the table. And I needed to also then tell him what I would need based on my numbers this year. Do I need to add any salespeople? Do I need to add any equipment? What do I need in the sales department to meet that sales goal? And then we would put a budget together around that, and we would look at any other support staff we'd need to add or anything else in order to meet that goal based on this year's number and proportion it out to project it into next year. Okay. So make sure you're thinking of next year's goals and where you want to take your business because bottom line is, and we're doing this for tax, but business success in general is also no accident. Okay. It is based on deliberate strategy, deliberately executed. And so those are some general principles. And now I'd like to, are there any questions or Boyd, would that be appropriate if anybody had any questions or do we need to move into Ron? I'll just go ahead and move into Ron then. Ron is one of the best guys I've known. I've known Ron now for 20 years or so. And it's taken me about that long to really understand what the heck he's doing at Pratt and Lefevre and to really get all of the moving parts in his strategy. Um, it's very sophisticated and brilliant. And I'm going to let him explain that. I just wanted you to know that as somebody that has been involved in business, my focus has basically been on growing sales, managing expenses. Taxes have just always seemed to me to be a necessary evil and something I just have to pay. But when I got to understand Ron's principles of how to handle this and how much money you can save on taxes to reinvest in your business growth. I'm really blown away by the genius of it all. Um, Ron has been in management accountant and has built this organization of Pratt and Lefevre, I think officially since 2008, even though he's been doing this strategy a lot longer than that. And so I would like to turn control of the meeting to Ron to let him talk about the genius of his system. Ron?
Well, I'll tell you something, Clay. Genius is one person, something that nobody's ever called me. But you're going to want to unshare your screen.
Okay.
Here we go.
Let's see.
I got it.
Did you
It's
unshare it?
it's unshared. We got it. It's done. I don't know who Hillsboo is. That's kind of cool name. Mercedes, nice to see you again. It's been a while. And Omalola, by the way, is one of our corporate attorneys and works with our processing department. She is very sharp, an attorney in business. Balaji, nice to see you. I haven't seen you in probably over a year, so it's really nice. And Ken Chase, so I know a lot of them here, and it's nice to have all of you here. Who's got the thumbs up? Who is that? Oh, Mike. Okay, nice to see you. And Chris, nice to see you. And Mercedes, nice to see you again. So let's talk a little bit about some of you guys have heard some of this, but I'd like to reiterate it because I don't care how long we've been working together. You're not always going to remember. And when you try to explain it to somebody else, I'm sure for the most part you don't. So I'm going to, well, let's see, I guess I better share my screen here before I get in any further. All right. So most of you have heard this, right? His business organization. John Rockefeller penned this logo, I guess you might call it, this thing, and it's called Own Nothing, Control Everything. And that's what we want you to be able to do. You don't make money by owning something. Whatever you own can be taken. You make money by controlling. Now, I like to have an interactive, and it's kind of hard when everybody speaks at the same time. If you have a question, please put that question in the chat, and Boyd will read that for me. Or I may put out a question for you. If you've got an answer, put it in the chat. I'm not going to be able to talk to everybody, but if you've got some sort of response or some sort of question, put it out there. Okay? Is that okay with you?
And I have a question for you, but it'll be toward the end, that
Okay.
someone else had asked earlier.
All right. So let's talk about the pros and cons of this concept. I'm going to tell you something, just a little bit about me. Okay. See if I can get it to go down here a little bit. There we go. I've been in business. Actually, I've been in business since I was 12. I delivered newspapers. I was in a small town. I had maybe 1,200 people in it. My buddy delivered the newspapers to half the town. I did the other half. And then I went into the military during Vietnam. Never had to go to Vietnam. I was stationed in Japan. But when I got back home in 1974, I bought myself my first real business. I'm going to tell you right now, I failed miserably, right? So the idea is know what you're doing. I lost a lot of money. I actually bought it from my mother. I gave it back to my mother and said, Mother, I can't do it. It's too much, right? So the idea is let's make it so that it works. This is part of my family when my wife and I celebrated our 30th birthday, our 30th anniversary. And since then, we've had more children. Right now, we have 9 children, and we have 22 grandchildren, and number 23 on the way. I love them dearly. My oldest son, Ron, is an attorney. David works for our company. My oldest son, Dan, is a licensed social worker. My son, Joe, is in public relations. My daughter is a school teacher. My oldest daughter, right over here, has a degree in psychology, but is a fitness instructor. And this daughter over here actually does some consulting work for our clients. Anyway, we're all in business. We know what we're doing, and I've done their taxes, and I have helped over 4,000 new businesses get started. That's my credentials. So if you've got any questions, feel free to ask. And I'm going to tell you what, I don't care about questions. I don't care whether they're good or whether they're bad or whether they're negative. It makes no difference to me. My belief is you don't hide things. I don't hide anything. I'll tell you anything that you want to know about me or anybody else, unless it's private information about my family. But I believe that we ought to be open and talk openly. These are my classifications. These are the people I belong to. This is my training, my certifications. I'm a member of the National Federation of Independent Business. I am a member of the National Society of Accountants. I'm a member of the American Institute of Certified Public Accountants. I'm also a member of the Chartered Institute of Management Accountants. I am a management accountant. And the National Business Management Consulting Association, I belong to that. Those are my credentials. I also went to school after I got my undergraduate work at the American College of Forensic Examiners. That's the one in the middle with the eagle. I am a forensic auditor, and I have a certification from the IRS itself by going through different classes with them, right? And I am certified as a small business tax professional. So I hope that you'll understand what we're trying to do. Here's my problem. Clay was good at explaining things the way that most accountants look at them. And he's very good at that. And Clay and I have been working together, I think since 2015, so about 10 or 12 years now. We've been working together for a long time. But here's the idea. When you're building a business, and it's not any different than building a house, you don't try to build a house by yourself. There are professionals out there that know more. I have several, and I'll show you some of them, right? I actually have in this company 45 people working with us on a national basis. We have 15 offices run by our professionals, a lot of them. I'm not going to be able to show you all their pictures today, but I'll show you some in a minute. But the idea is when you're building something, building a business especially, you need to have advisors. You need a good accountant. You need to know your numbers. And Clay said exactly the same thing, right? But in addition to an accountant, you need to know your legal. You've got to have a good attorney. You've got to make sure you don't do things illegally. And we're going to teach you some things today that are very often looked over and looked past as accountants and CPAs. Okay. And then there's one other thing that you've got to have that you probably don't realize. What happens to your business if you die? You've got to have an estate planner. You've got to have your estate be one of the owners of the business. Because if you do that and something happens to you, your estate, your trust can take over the business without probate, continue to make money for your beneficiaries, for your posterity. And then they're going to be working with you as the management. Because as the management, you know your business, but there's many things you don't know. And I would be the first one to acknowledge that there's a lot of things I don't know. When I got out of college, I have continued to study, to learn. I've been to hundreds of different classes put on by different professionals. And right now in our company, we have 80 professionals working for us, either as advisors or actually part of our team. Okay? But look at it. They're looking at it from different directions. They don't see it the same way you do. right? And you don't see it the same way they do. When I had that first business that I just showed you there, I had a good accountant, I had an attorney. I'd get advice from my accountant, I'd get advice from my attorney, and they often were conflicting. I didn't know who to believe because they weren't the same. We want you to be able to work with professionals that give you the benefits of doing it the same way so that they don't step on your toes. Okay? Most small businesses start like this. To build the business, they call themselves a business. And you got to remember, we're not doing business like they did back in the old cowboy days. The cowboy days, you could have a store, you could get all of this in, you knew your money, you took care of everything. Um, you didn't have to worry about being structured a particular way. Today's society, we have started differently. Even though the business may be ugly at first, make it solid. Hire the professionals, get the right ones in place. Have a good foundation from which to grow. Okay? This is the main people we've got going right now. You just heard from Clay today, right? But we've also got all of these other people. Plus, I've got 4 more that I didn't have room to put their pictures on. I hope that they're not watching this and thinking I left them off. They're good, right? Joe, for instance, runs our West Coast. Ron Coleman runs our website and also does a lot of marketing online. Jeff Wood is one of our CPAs and also a financial advisor. He does things for clients. I don't know everything. I don't want to know everything. That's why these guys are here. Boyd, you've been talking to. Keith is our accounting department manager, does an absolutely marvelous job. Erin, ERIN, is our corporate treasurer and works with Keith to make sure that the books are done. Okay. Brandon is the head of our tax department, is very good. Roger Alexander used to be a client, came on with as a client in 2017, and has now taken over the company as the president and chief of operations. And then my ugly picture at the very far end. And based on what these guys know, I know nothing. But I try to show you things that perhaps you don't know as well. Okay? Oh, I don't need to do that. I'm going to get that out of there. Sorry. I hit the wrong button. There we go. All right. So now let's go here. Oh, there we go. What you need to do is to have different businesses of different strengths, of different sizes, working together. And you've got to manage them. You've got to balance them. And you can't do it by yourself. Okay? So here are the different types of businesses. I'm going to put some of them up, and I'm going to ask you just to put in there a little bit in your response. What do you know about these different businesses? And what kind of a business are you? Are you a C corporation? Now, I've heard a lot of people say, I don't want to be a C corporation. There's too many requirements. I'm going to tell you, in my opinion, that a C corporation gives you more benefits and operations, and you can operate simply, right? I don't know whether you see this on here or not, but I got to get over here. Got to get that out of the way. Okay. So, do you need all of the business structures or you need one? When do you need it? How come you need it? C corporations and S corporations are similar, but how about an LLC? If an LLC is there, there's some things you need to be concerned with. First off, you cannot and should not be a single member LLC. By the show of hands, how many of you in here are single member LLCs? Mike, or I mean, Boyd, can you see any hands coming up?
I know. By the way, you can use down at the bottom, there is a react button. And when you click the up arrow on it, it allows you to raise your hand. Or you can put the heart on it. There's several things you can do. But there was only the one.
Okay. If you need to be a multi-member LLC, but That's not how you're taxed. You're not taxed as an LLC. You're either taxed as a C corporation or an S corporation or other types of entities. Those are the two main entities. But a C corporation is filed with the state as a C corporation and with the IRS as a C corporation. Their designations are identical. But with an S corporation, you are filed either as an LLC or a sole proprietor or something, and then taxed as an S corp. So S corporation is solely a tax designation. Okay. And the one thing about it is that if you are taxed as an S corporation, the IRS considers you a corporation. You have to be structured and organized and operate as a corporation. You have to have officers, board of directors, shareholders. You have to have all of that stuff, but not with the state. With the state, you don't have to do that. You're still an LLC. So you get a little bit of a conflict there. With an S corporation, and most people don't know this because most of the times I've seen that other accountants recommend, especially if you're a sole proprietor or a single member LLC, that you be taxed as an S corp. Most people don't know this, and I've had to teach a lot of CPAs. S corporations have 23 tax disadvantages and only one advantage. So the best way to get your most tax out of these things is to have more than one organization, just like I showed you before. And we always recommend a C corporation and an LLC, and I'll show you why in just a minute. And here are the different types of partnerships. Okay, general partnership or limited partnerships. And there are tax advantages and disadvantages to both. Sole proprietors. A sole proprietor means you are the one that's in charge. You're just like the old pioneers. You got your own store, you got your own operation, you do everything, right? And I would suggest that if somebody comes after you, you would lose everything you own, including your house and cars, furniture, everything, through a sole proprietor, and also through general and limited partnerships. There's really nothing in those organizations that protects you. Then you need a family trust. And there's two types of trust: revocable, which we call living because it moves, it's fluid. The person's putting it together are grantors. They can bring in things in, they can put things out, they can put the people in it that they want. It's their organization. And it too doesn't protect your assets. But a lot of people will use an irrevocable trust, which means that protects your assets, but you don't control it. You have to walk away from it, and somebody else is in charge. So there's a reason that we use the family trust as an revocable or a sole proprietor trust, somebody that is just owned as a living trust, right? And they work with the other entities, but these trusts, a living trust, will own no assets. I'm going to show you these things. If you ever want to talk to me, I'll help you understand it, right? When you're building your business, though, in one of these organizations, and we use a C corporation and an LLC and a trust together, I'll show you how to do that, right? But remember, make it simple. Anybody here know what the KISS principle is? Okay, the KISS stands for keep it simple, stupid. My wife, though, doesn't like me to call people stupid, even though I have on occasion. But I always say, keep it stupidly simple. Dumb it down. Don't make it complicated. You can run a C corporation easily. It's not difficult to run. It's not difficult to do it. But remember, when you have an organization, you have to follow the rules. Okay? And so we want to make it so that you can easily get in it and get it started, easy to manage, but if somebody comes after you, easy to walk out of it without losing anything. But to do this, you've got to do it correctly. It's called related parties. You are related to your business. I don't care how many structures you've got. You're related to each one. Each one of them are related to each other. You've got to be doing it by the formalities so that you don't have a conflict of interest. You may get in and be able to work in behalf of them, but you don't work with all of them and do all of them at the same time.
Ron,
Paperwork is critical. Yes.
Ron, I have a question here from Ken. He was asking, how common is it to have a lawsuit that risks your assets? Have you seen it with any of our clients?
How about with me?
You've seen it,
Yes.
and has been,
So
so this system has been successful in preserving assets.
that's correct.
Yep.
Absolutely. Because they're following the rules. Dr. Weiner here, who is a tax professional, he's a Juris Doctor and also a tax professional lawyer, right? Puts it out this way. Small businesses have to follow related party transactions. So just for your information, in 2005, I started my other accounting firm, had another accounting firm, and did really well from 2005 until 2007. The beginning of in the middle of 6 to the end of 7, I had 160 banks I was dealing with. We were heavily invested in real estate with our clients. We'd invest money in their LLC. They would run the LLC. We'd do the taxes. We did the consulting. We did all of those things. In 2007, I had to close that accounting firm down because we lost a lot of money. As you know, in 2008, and everybody said it was 2008, but it started in the middle of 2006. And we were losing money. We had hundreds of people that were tenants of our properties were walking away. Couldn't get money out of them because the money was scarce. Between 06 and 07, like I told you, we lost 160 banks. And at the end of 07, I told my clients I would take and walk away from my investment in their company if they wanted to do something with it to help them save it. Between that and 06 and 07, we had 93 houses that we'd invested in went bankrupt, and the IRS and the banks foreclosed on them. We lost over $1 million of investment, and then I had my dream home, 6,600 square feet, 8 bedrooms, kitchen, swimming pool, sauna, 3 acres, 12 apple trees, or 12 different types of fruit trees. And that was my dream home. I ended up having to sell it because I couldn't afford the payments for it. And I sold it and walked away from another $500,000. I lost more than $1.5 million because of that market crash and had nothing taken from me. Nobody sued me. Nobody could sue me because I owned nothing. But I controlled everything. Okay. And I also made sure I followed the rules, the real estate rules. Related party transactions is IRS code 267. Very few people study this. Very few people really understand it. And related party says if you're going to not have a conflict of interest, you follow the rules, the formalities, the contracts. You don't move money between entities without a legal contract, without following the rules. And that's what we try to help our clients do right now. Okay? What we want you to do is to take advantage of being able to hide in one or more of the entities so that if somebody comes over and tried to sue you, they'd have to go through the company because you're not acting for yourself. You're acting for the business. So when you're part of the corporation, you are the corporation. But when you're part of the LLC, you're no longer part of the corporation. You're part of the LLC. And you're part of the trust as the trustee. But only the trust owns the corporation. You don't own it. but you are the main officer. Your spouse is another officer. Somebody else is another officer. You only have 3 people in there, and you keep control of all of that stuff. Otherwise, you're just like a pup tent. Some big wind comes along and blows it down, you get soaked. We don't want you to worry about that. Okay? Now, here's one of the benefits that Clay talked to you about a little bit, right? You can have an office in your home. And as an office in your home, you get just to designate the cost for that one office. The rest of the home is yours, right? You calculate the percentage of the total square footage of the house. You deduct only the percentage of the home and the utilities and the other costs. Okay? And if that happens, 90% of the time, my clients get audited that do that because they cheat. They don't know how to put the costs in the right direction. Okay? What if, though, we could take the whole house and write off all of the expenses for the entire house? To do that, you could no longer own your house, but you would have an LLC that owns it. The LLC pays the utilities, the maintenance, the insurance, the taxes, anything having to do with it. And Boyd also talked about depreciation. You could depreciate 100% of that home's value and write that off as a tax deduction. Okay? These are things we can do. Now, ask yourself, and I want you to put this in the chat. Everyone will put something in there. What's the most beneficial business expense for businesses? Anybody tell me? What do you think? No answers? Clay, what do you think?
There's a few people putting things in like salaries, interest, travel. Repeat the question, Ken asked.
What is the most important business expense? What do you think, Clay? What have we got?
My paycheck is what Ken said.
Probably true, all right. Probably true. However, Ken, what if we set it up where you don't get a paycheck? You can get money out of it, and your business pays all of the telephone, all of the rent or mortgage, travel, meals, paperwork. It pays for every business expense, and you never have to worry about it at all. It never comes out of your pocket. That's the most important one, is the one that your business organization can pay for, and you don't get charged as a taxable income, as a taxable event. Okay? So here's a question for you. What's most important? Profit or cash flow? Tell me what you think. What's the responses, Boyd? Anything?
Nothing quite yet. Oh, cash flow is the number one answer.
Okay. Well, if cash flow is the number one answer, what happens if we have a profit? What are we going to do with the profit? If you get profit in your business, you pay the taxes. Well, not
Like
quite.
like Ken said, I really need profit, but the bottom line is you pay taxes on profit.
Correct. That is exactly correct. So let's show you how to keep the profit yourself. Wouldn't it be nice to have profit in your business organization and use it for your business growth and not have to pay taxes on it? You get to control the money. Remember, control everything. Money is your most important asset to control. And we want you to keep that profit, but keep it and not pay taxes on it. Okay? So let's talk about how you, as a W-2 employee, I'm assuming that most of you or somebody in your family are W-2 employees. Okay? So let's say that you make $5,000 a year, $5,000 a year, yes. Okay? And you get paid
That's a month.
not a month. $5,000 a month. Yes, that's correct. Okay. make $5,000 a month as income, and you're the standard tax bracket, which is about 15%, you'd be paying $750. Comes right out of your paycheck. You never even see it, right? And then you have to pay for expenses, and you've got at least $3,000 in expenses. Okay? There's your expenses. Everybody has to pay them. And if you pay those with after-tax dollars, you really don't have a lot of money left over. Okay? And if you're paying $750 a month in taxes, you're paying the government $9,000 every year. Right? And you may not even get a refund, and you try to get a refund, but it's up to the government whether you get an interest refund, and they get to keep the money at no interest, or you don't even have to pay interest to them for it. They don't pay you interest, even though it's your money. So if they're going to pay you the $1,250, you get no interest in that. You're just hoping you don't have to pay more, right? So what we want you to do is to take these fixed expenses and pay them with your business as after-tax expenses. You get the same money, but you pay the taxes first. Or not after tax, before tax expenses, right? And now you only got $2,000 a month you have to pay taxes on, and your tax bracket may be twice as high, so you're paying 30% instead of 15%. But even with that, you pay less tax. You get to keep the money. You have a $150 gain between paying tax the first way or paying it the second way. So what we want you to do is to take your expenses and make them business expenses. Okay? Now, let's talk about paying the taxes and who pays the taxes. Let's say you've got a box, and the box has 4 sides and a bottom. A corporation, right, pays its own tax. It's self-contained. The money goes in. If there's money left in the bottom of the box, and if you pull money out, you have to pay taxes on it twice. One, because that's your personal income, and second, because the corporation has profits. Whatever's left over in the bottom of the box is profit. And the corporation is self-contained. It pays the tax. You don't pay it. But as the officers of that company, you got to make sure that the corporation pays it, or you could go to jail. Right? But let's take you. In the bottom of the box, let's say it's an LLC. In the bottom of the box, you are either an LLC or a sole proprietorship or a partnership. It's pass-through. The bottom of the box has a hole in the bottom. During the tax year, the hole is plugged. At the end of the tax year, the plug is pulled. Anything left over to the bottom of the box, you pay the tax on it. That's taxable income. Okay? We don't want to have anybody like that because it's pass-through where you pay the taxes, right? We don't want to have you pay the taxes. We don't want the LLC to pay the taxes. So how do we avoid that? Right? The first thing we're going to do for the corporation is have a fiscal year. A fiscal year means you can start the tax year anywhere in the middle of the year, and then 12 months later you do your taxes. Okay? And the LLC though is a pass-through. Partnerships are pass-through. Sole proprietorships, all of those things are pass-through. It means in the bottom of the box, it's got a hole. You pull the plug, and everything passes to you. So what happens here if the LLC or the pass-through passes the money here to you, and you get to use that money, and you don't have to pay taxes on it? But because the LLC has no money left in the box, you don't have to file a business tax return. You file it, but you have no obligation. Okay? So let's talk about a non-cash expense. Everything else you pay, all the ones I showed you are cash expenses. Telephone, rent, business meals, operations, organization, everything that you have to pay in taxes is cash out of the box. If there's cash in the box, you don't get to use it. You don't get to keep it. Same way with the corporation, right? What we want is a non-cash expense. And what is a non-cash expense? Depreciation, right? Depreciation lets you keep the money and use it how you want to for business growth. But there's no tax on it because it reduces the tax by not paying it in cash. Okay? So let's say we've got the two corporations or two organizations together. A C corporation, not an S corp, because S corporations cannot do this. But a C corporation is one of them. A C corporation pays its own tax. And then you have the LLC, which you manage. Actually, you're going to manage both of them. But when you're in the C corporation, you don't own the C corporation, you manage it. When you're over in the LLC, you and your spouse will own 90%, and your trust will own the other 10% for estate planning purposes. Now, we have a profit. We don't want you to have a profit, right? But the corporation can have a zero profit, right? But the owner doesn't have to pay the taxes on it, right? They get to be the managers, but there's no cash profit. Then you've got the LLC over here, and the LLC is completely different. The LLC over here gets the money, but if there's a profit, you have to pay it. Or a loss, you get to take the loss and you get to pass it on. So the idea is, if you're going to do that, the corporation has too much money. It has to spend the money, buy a cash expense in order to reduce the profit to zero. And it does that because in the formalities, the corporation is going to have three contracts. The first contract is it's going to rent your cars. The LLC is going to own the cars, but the corporation pays all of the gas, oil, tires, maintenance, anything having to do with ownership, with operations. You don't own it. The LLC owns the car, and the corporation pays rent to the LLC. So the LLC gets money. Now, why is that good? Because the corporation's tax year is a fiscal year. I hope everybody understands what a fiscal year is. So we in our company here, we try to start corporations on the beginning of a quarter, April, July, October. And it goes then for another 12 months. So let's say we start this in July. And the corporation has to declare profits in June or at the end of June. Just like Clay said, at the end of the year. So LLC's cash year is December or January through December. It can't do tax planning until from the tax period. You can't do tax reduction until after the end of the year. It has to be done before the end of the year, right? The LLC then, because of that, needs a place to put its money. The corporation has money left over in June, and it has by contract a management agreement with the LLC where the corporation provides services for the LLC. The LLC sends the corporation an invoice, and the corporation pays that invoice to the LLC. So on a cash expense, because of the formalities, it can pay the money to the LLC. The LLC now has it, but it doesn't have to show the income for 6 more months. Now the LLC builds the business. It buys assets. It does things to move the business, get it grow, have some sort of an expense there that is an expense that will make money and growth for your business. And then the LLC at the end of the year has money left over, And the LLC then gets an invoice from the corporation. The corporation pays that invoice, or pays that the LLC pays that money to the corporation, and the corporation doesn't show it as income for 6 more months. And now it builds the business. It spends it. It doesn't just keep it. So it's not the same amount every year, and it should be less and less all the time because you want to build, you want to use that money to build your business and help it grow.
Ron,
Yes.
we got we're running out of time. In fact, we're
Okay.
out of time. But I have a person who's asked a question. I told him that you probably want to meet with him in person. It's Ken Chase, and he says, "What are the consequences if you get everything set up for this and you get really busy and are not able to keep up with the requirements, bookkeeping, and red tape?"
That's why we're here, right? You want to meet with somebody that's a CFO, and it's either me or Brandon or somebody like that that's a qualified CFO to help you do your tax planning every 3 months. So we just don't do this at the end of the year. And it's up to you to be proactive and set up those times. Okay? And what we're going to do is use the depreciation, and because the LLC has a zero cash profit, we're going to depreciate all of the assets, and the LLC owns every car, your entire house, all your furniture, all your business equipment, and depreciates it, which puts the LLC at a loss. You show that loss on your income tax, and it reduces your taxable liability. Okay? So what we want to do is to move it between the LLC and the corporation and the corporation and the LLC to have them work together. Okay? They have a fiscal year. The LLC has a calendar year, and that's the only way you can get it to work. And they pay each other because of contracts, formalities. Okay? Now, I know Boyd says we're out of town, so let me just show you how we get it organized. First is the corporation owns no assets. It's the publicly visible image, and its only owner is your trust. And then you have an LLC which owns all your assets, rents them to the corporation, and then pays the taxes on them and other things that for the assets themselves. But if there's a loss, they get to do it, and if there's a profit, we're going to pass the profit on to you, the sole proprietor. So you get to do it, but because of the LLC's loss, you claim your income as a sole proprietor, but you don't have to pay as much because you get to write that loss off, which reduces your taxes drastically. So what we want to do, Ken, we just said to you is we know where the rocks are. We can keep you from getting soaked.